Welcome to the another class on your investment decisions under certainty. Yesterday we talked about the kinds of projects, the nature, and the various steps that we follow for effective project management. Today, our discussion is going to be centered around the investment appraisal and the various evaluation criteria. If we talk about, the place where we are going to invest or in a long term, that is what is known as the investment capex, and how we go for decision making in that case. That is what we will be discussing in today's class. Now, the investment decision of any fund, it is usually we call it by many names: long-term investment decision, capital budgeting, capital expenditure, most stylized form is capex. Now, as we discussed yesterday also, that the kinds of projects, so this kind of investment decision could be in the form of expanding existing business, acquiring a new business, modernizing your operations, or replacement of the long-term assets. Sometimes this method of sales distribution, advertisement campaign, the R&D program run by a company, they also classify as project, and that also because that requires capital expenditure. Now, we'll talk about these various features of your investment decision. Now, in the investment decision is a very important decision-making area for the finance manager, because it involves the exchange of current funds for future benefits. So when I'm talking about a project, or when I'm talking about an investment for a long-term basis, basically I know that I'm going to commit a huge amount of fund for something that I expect that it will give me benefits over a very long period of time in future, and the time could be as long as 20 years, as I said. So 5 years, 10 years, 15 years, 20 years. So it can give me benefit over a future long period of time. Now, usually we invest these assets, invest this money in long-term assets. By long-term assets, we mean that it is an asset which will give us benefit over a long period of time. And the future benefit will come to the farm over a very long period of time. So this is the essential nature of your investment decision. Now, the importance, why this kind of decisions are important is because number one, they directly contribute towards the growth of an organization. Now, if you go for good projects which give you good rate of return, then whatever you are investing, you get more money in return of that. So basically, the organization becomes richer, it acquires more financial resources, and it keeps on growing. So it has a direct relationship with the growth of the farm. These decisions are very risky because you because of this the next the remaining points, that is, they involve a high amount of funding, they're irreversible in nature, and they're very complex in nature. Now, due to these three factors, the investment decision is considered very, very risky, because you're committing a huge amount of fund, and second, the amount of fund that you're committing, if you after committing the fund, if you realize that I have made a mistake, then probably there is virtually no way to go back and dispose of your, even if you want to dispose of it, you will do it at a lot of loss. Also, this kind of decision making are very complex. So the investment decisions are, though they have a very good impact on the growth, but they are very risky in nature. Yesterday we talked about some of the classification of project. Similarly, we can classify these projects as, let us say, the existing. We can expand the existing business. We can expand new business, which we call as diversification. We can talk about replacing an asset, or modernizing the processes. So this kind of classification is one kind of classification, but you can have another kind of classification wherein you talk about the exclusivity of the project. The project could be mutually exclusive, I mean, if you invest in one as area, you cannot go for the other. For example, if you have 5 crore rupee available and you are considering buying replacing a machine, and the alternate machine, suppose there is a machine 1, there is a machine 2, and one of the machine costs you 4 crore, the other one costs you 4.5 crore. So and your budget available is 5 crore, so obviously you will either choose machine 1 or machine 2. So in that case, choice of one discards, automatically discards the machine 2, I mean the other machine. So in that case, we say that these are a mutually exclusive kind of investment, that is choosing one will automatically discard the remaining options. There are some other kind of investment activities which are independent. That means the choice of one will not discard the probability of the other being chosen. So these are independent investments, and in contingent or also known as dependent, they are the investments which if you have to go for this, you have to go for that also. So both the kinds of investments are needed. For example, if you plan to set up a factory in a remote area, it is contingent upon the road accessibility to that particular area. Suppose if it is not accessible by road and then you are trying to set up a plant there, so setting up the plant is contingent upon the accessibility to the place where you are I mean the accessibility of the place by road. So you have to invest in both these things. So these are called the contingent investment. Then we talk about the various investment criteria, like how do we go about making these investment decisions. Number one is that you have to estimate the cash flows. Please keep it in mind that when we talk about this, one might tend to be tempted to believe that if we look at the net profit figures and we can project the net profit figures, then probably that will be helpful in the estimating the cash flow. But please keep it in mind that the profit that is reported in the financial statements, they are not cash. Many times a farm might be posting good amount of profit, but it might be cash crunched, liquid, they called as the liquidity crunch. Now so the profit and the cash, they are not the same. So you need to adjust the cash, I mean the profit, by little bit. Some iterations have to be done so that you get the cash flow, and these cash flows have to be estimated. So before you estimate the cash flow, you have to know this investment is going to last for how many years. That means it's going to give you benefit for how many years. Suppose that means you are estimating the economic life of your project. So if your economic life says that it should be giving me cash flow for 12 years, then you have to estimate the cash flow for 12 years. And as I said, that you have to do adjustment to the profit figure to be able to estimate the cash flow. The next is your estimation of once you have done the estimation of cash flow, the next step that comes is computation of the cost of capital. Now we have already covered the cost of capital, and you already have the skill and the resources to compute the cost of capital. This same cost of capital, or the opportunity cost of capital, is what we are going to use here for decision making. So this is the required rate of return of the firm or the cost of capital. So which we have already done. Then we talk about actually applying a decision rule for making the choice. Now, when we're talking about whether to invest in this particular place or not to invest in this particular place, then you have a lot of techniques available to decide whether it is to be applied or not to be applied, or whether it is to be accepted or not to be accepted. So there are a lot of decision making rules, and in this current class, the major focus in this step 3. Now, how do we evaluate? Now, the evaluation can be done through two methods. One is a non-discounted method, and the other one is a discounted method. Now, the what is the meaning of discounting? Is the basically, suppose I am going to receive some cash benefit after 5 years. Suppose that amount is 5 lakh. So if I tend to think that today my cash receipt is 5 lakh, it is going to be very, very erroneous. Now, because something that I'm going to receive in future has a different value today, and that value is called as the present value. So, when we're talking about evaluating and I'm estimating the future 12 years cash flow, and then I cannot simply sum up those 12 years cash flow and then take a decision. So, basically, what we do is in case of non-discounted cash flow, now see. If I give you a timeline here, for example, this is a timeline. Today represents time zero. Suppose your project is going to last for 5 years. So this is year 1, 2, 3, 4. Suppose 6 years, 5 and 6. Now suppose your project is going to last for 6 years. Now here you are committing this amount of money. Okay, and you are going to get some small amounts of money in the future for 6 years. Now my decision is whether I am going to commit this particular fund to get this cash flow or not. The common sense tells me that if this total cash flow, the total cash flow that I'm going to receive for the next 6 years period, if it is greater than the sum of money I'm committing here at time zero, then I should invest. And if this sum of money, the total sum of money, if it is lesser than the current sum of money that I'm committing is lesser than that, then I should not be investing in this project. But everything said and done, I just cannot sum up these sums of money. It is not allowed. Simply, it is not allowed to sum up this money and then compare it with. So, what is the correct process? The correct process is to bring all these values to today's time frame. So, if I can somehow use some kind of methodology to bring these values here to a common point of time reference, then we can say that now I can compare this with this, and then I can go for decision making. So this entire process of bringing the value of the computing the value of the cash that I'm going to receive in future, computing the value here today's time, this entire process of bringing it back is known as discounting. Now the point is, there are some techniques which talk about using this kind of discounting. They go for decision making, and there are some other techniques which don't use these discounted techniques. They just simply add up the cash. So these techniques which simply add up the cash are known as the non-discounted cash flow criteria, and the ones which discount the cash flow and then add, they are known as the discounted cash flow criteria. So likewise, accordingly, I'll tell you about both these criteria: two under discounted criteria and the three under non-discounted criteria. The first non-discounted criteria, and which is the readily referred, anybody talks about this thing in real life also, is payback. Now, when I talk about payback, payback is basically the number of years that you require for your original cash to come back to you. So, it is the time that you require to recover your initial investment is known as the payback. If the project generates constant annual, meaning that suppose you invest a sum of money here, and suppose 1, 2, 3, 4, 5. For 5 years, you are going to get some amount of capital. I mean, you are receiving some amount of money. Then you say that these are level cash flows. Okay, constant annual cash flows, or annuity, basically. You also known as annuity. Now, if this is the scenario, then the payback period can easily be calculated. Now, how can we calculate? We can calculate it by initial investment C0 divided by the annual cash flow. For example, here, if your project requires an outlay is an outflow of, let us say, 50,000, then and you are getting, you are getting cash out. This thing, inflow of 12,500, then what is your payback period? Your payback period is simply, your simply payback period is 50,000 by 12,500. So that comes to 4. Okay. So your payback period is 4 years. Your total payback period is, so that means in 4 years, so obviously first 2 years 25,000, second 2 years 25,000, so you recover your initial capital of 50,000 in 4 years. But if you have uneven cash flow or unequal cash flow in each year, then you simply cannot have any formula, but you have to talk about a cumulative cash flow, and then you can decide like what is the actual recovery period. Now, suppose, if, for example, if you have a project that requires a cash outlay of 20,000 and it can generate cash inflow of 8,000, 7,000, 4,000, and 3,000 during the next 4 years, what is the project's payback? Now, to solve this, what I need to do is, see, for example, here I can do a cumulative one. I'll write here as year, and then here I'll put the cash flow. So here 1, 2, 3, 4. I think I have 4 years cash flow. Now, what are the cash flows? 8,000, 7,000, 4,000, and 3,000. So I'll prepare a cumulative cash flow, cumulative cash flow. So first year is as it is 8,000. Second year will be added here. So 15,000, sorry, 15,000. And the third year will be added to this, then that is 19,000. And the fourth year will be added 22,000. Now, what is my initial investment? My initial investment is 20,000. So, the recovery period is within the third year and the fourth year. Well, you can exactly compute how much will be the recovery period. Like, for example, in this year, you are receiving 3 years additional. So, but you need from 19,000, you will need another 1,000 recovery. So, which means that you would make an assumption that the remaining 3,000 rupees is received over a period of 12 months equally. So in 12 months you receive 3,000, and in 3 months, that is 12 by 3,000 into 3. Sorry, not this. Not this. 3,000 divided by into 3 by 3,000 by 1,000 divided by 12. Okay, so this will tell you exactly in how many. Okay, in how many months you can recover that particular period, right? So the what is going to be the acceptance rule? Now the project it will be accepted if your payback period is less than the maximum or the standard payback period set by management. Now, for example, if you have for example, if you suppose your standard payback period is, let us say, 3 years. Now, any project which is having less than 3 year payback will be accepted, and any project which has a payback period more than 3 years, it will be rejected. So this depends on the standard that you are setting for yourself. Now, payback can also rank projects in the sense that I mean, if you have two projects, one is having a payback of 3 years and another one is having a payback of 4 years, then you can simply rank the one which is lower payback period as rank 1 and higher payback period as the rank 2. So higher the lower the payback, better the project. Okay. Now, the next method is your accounting rate of return or the return on investment. This is another technique that we can use to evaluate our projects. This is also known as the return on investment, I mean return on asset, or simply the accounting rate of return. Why it is accounting rate of return? Because all this data that we can that we talk about here can be availed from the accounting statements only. So the name is accounting rate of return. Now it is basically how do you compute the accounting rate of return is the average income by the average investment, and this is a non-DCF criteria. So basically you just simply add up the cash without considering the present value. Here is an example. Now the example is that the project is going to cost you let us say 40,000, and the stream of let us say benefits that you are going to receive are like this: 10,000, 12,000, 14,000, 16,000, 20,000. And if you assume it a 50% tax rate and depreciation on a straight line basis, then what can you do? Now see here, I have given you the formula for that, that this EBIT into 1 minus tax. So what we can do is, let us say here I say this is my EBITDA. Interest before end, EBITDA, and these are my EBIT. So if I deduct from EBIT the depreciation figure, then I get, so suppose first year my cash flow is 10,000 rupees. Now what is going to be my depreciation? My depreciation is straight line method. The project is costing me 40,000, and the life of the project is 5 years. So 40 divided by 5, 8,000 rupees is going to be my depreciation. So if suppose I put a line of depreciation, depreciation is going to be 8,000. So my EBIT is 10,000 minus 8,000, that is 2,000. For the second year, my this thing is going to be, the cash flow is going to be 12,000, because it's straight line method of depreciation. Again, it is 8,000. So you have here 4,000. Similarly, you have here 4,000. Here you have 6,000. The EBIT is 6,000, and then here you have 8,000, and here you have 12,000. Okay. Now, as per your formula, it is EBIT into 1 minus tax rate. So what I am going to do is make a column here, which is EBIT into 1 minus tax, into 1 minus tax rate. My tax rate here is 50%, which means that I'll deduct 50% from this. So this is going to be 1,000. This is going to be 2,000. This is going to be 3,000. This is 4,000, and this is 6,000. So if I add up, this is going to be my sum. I get the numerator, and that is 16,000. Okay, this is going to be my 16,000. In numerator, I have summation divided by n. So my numerator is average income. So ROA is my average income. Average income is, this is my total income, 16,000 divided by 5. 16,000 divided by n is by 5 years. And bottom is the average investment. Average investment is 40,000 initial investment plus 0 divided by 2. So this works out to, let us say, 3,200, and this works out to 20,000. So now I can compute the rate of return here. So I guess it will be somewhere around, let us say, probably 16,000. 16% is going to be 16%. Okay, so this is how you compute the return on asset or the ARR, accounting rate of return. Now it will accept again. There is a set management criteria, and if you ROI, suppose your management criteria is that every project which is having 15% or more will be accepted. So right now we computed this rate of return as 16%, so that will be accepted. Below 16 15% it will be rejected. Now again this method will rank the ones which have higher ROA as a better rank and lower ROA as a lower rank. Now we come to the next criteria, which are the discounted cash flow criteria. So here, what we have to do is we have to discount the cash flows before going for a decision making. Now the cash flow of the investment, we have already estimated. We have already, as I told you, we have already also having the cost of capital at our hand. Now with these two figures, we have to compute the net present value. So net present value is nothing but the total present value of all the benefits. Now suppose, as I told you, that showing a timeline, my this is time zero, so whatever is happening at time zero is already present value. So these are your future cash flows. Now if you discount them, all of them here, and sum it up here, this is going to be your these are the discounted values. Now this sum it up here, this value is known as the gross present value. Okay, and from gross present value, if you this is called as the initial investment or the initial cash flow. So if you deduct the C0 from the gross present value, you get the net present value. So basically net present value is your gross present value minus your initial investment C0. Some also refer to it as a I0. So investment at point 0 or cash flow at point 0. Now, obviously, what is the acceptance criterion here? That you accept the project if the NPV is greater than 0, which means that your gross present value or the present value of the benefits, if it is exceeding the present value of the cost, then the NPV will be positive, so you accept the project. If we look at the formula of NPV, this is how it will look like. Now suppose here you have, we do not know how many years the cash flow will be happening. So from C1 to Cn. Now please keep it in mind that the C is, these C's could be same, these C's could be different. The formula is not sensitive to the cash flow that we are reporting here. The formula will apply to all sorts of cash flow. And the K here is the cost of capital. So basically what I'm doing is I'm summing up all this cash flow, present value of all this cash flow. So this particular figure in the formula, this is known as the gross present value minus whatever investment you are making at current time, that is the C0. So you get the net present value. Now if your net present value is positive, accept. If it is negative, then you reject. If it is 0, obviously you are indifferent to the project. Now why positive we should be accepting? Because it ultimately in present value terms, in today's terms, if I'm putting 100 rupee in an investment and I'm getting in today's value, if I'm getting 110, it means that I'm becoming wealthier, I'm becoming richer by an amount which is 10 rupee. So because I put in 100 rupee, I get 110, so I become richer. So I should invest in this kind of project. But if you are putting in 100 rupee today, and in today's terms, in present value terms, if you are getting, let's say 98 rupees, then obviously the 2 rupees going from your own pocket, which means that you are becoming poorer if you are considering this investment proposal or this project. So you should discard this kind of projects because they don't add value to your farm. So anything, any NPV which is positive has to be accepted, and an NPV which is negative will be rejected. Now here is an example that if suppose you're talking about a project X, which is cost of the project is 2,500, and it will generate these year-end cash flows for, let us say, 5 years, like 900, 800, 700, 600, and 500 in year 1 through 5. See, I'm giving you very, very simplistic examples just to understand how it works. And since we're talking about certain cash flows, so I'm giving you the cash flows. In real life, you will actually be able to estimate these cash flows because we're talking about certainty. But if your cash flows are uncertain, this estimation will become difficult. So we'll deal with that in the next session. Now, this is the case, and your opportunity cost of capital is 10%. How do you go about solving the NPV? Please see, this is how your NPV will be solved. Now, you discount each of these cash flows like 900 once, 800 twice at 10%. So, and then sum up. So, this is how you get the compute the NPV. So, your NPV is a positive of 225 rupees. So, obviously, you will invest in this kind of a project. It is acceptable to you. So, this is your acceptance criteria. You accept the project when NPV is positive and more than 0. You reject the project when it is negative, less than 0. So as I told you, why a positive NPV is important and why the negative NPV is to be rejected, because they directly contribute to the wealth of the company. And you may accept or may reject if it is equal to 0, because it is neither adding to your value nor it is reducing your value. Now, there is a very peculiar characteristic of NPV, that is, in fact, among all the 5 techniques that we are discussing in today's class, this property is only, it belongs to NPV. Number one is that it can correctly select between the mutually exclusive projects. Plus, the greatest benefit of NPV is that if you can bundle projects together, and because while bundling projects together, you don't have to recalculate the cash flows. For example, let us say you have, let us say, 15 lakh rupee available. Okay, and here you have choices between these projects. You have a project A which is going to cost you, let us say, 15 lakh, and you have a project B which is going to cost you 10 lakh, and another project C which is going to cost you 5 lakh. Okay, 5 lakh. Now the point is, if I have to take a decision of investing this 15 lakh, I can do so by either going for project A and invest the entire money, or I can go to project B and C together, 10 lakh and 5 lakh. Now see, the project B will have a different, it has different investment and different set of cash flows. Similarly, project C will have different investment and different set of cash flows. So you might think that then the computation of NPV might be difficult. No, it is not difficult, because if compute the NPV of B, here you compute the NPV of B and you compute the NPV of C by taking into account the initial investment and the subsequent cash flows. In both cases, you simply add them up, because NPV is value additive. So this operation is, it holds good in case of NPV. It does not hold good for payback. It does not hold good for ARR or any other method that we're discussing. Does not hold good for any method. It only holds good for NPV. So now I can compare project A with the bundle of project called B and C through this NPV. So this is a wonderful technique for which this has the maximum usage in the industry. So the NPVs are value additive and they directly contribute to the wealth of the company. So this is one of the best techniques to be used in case of project evaluation. Then there is something called the internal rate of return. Well, you can say the internal rate of return is nothing but the ROI of the project. But why we use the name internal here is that to compute this rate of return, you don't really need look at uh, any external factors. You don't need any external input to compute this rate of return. All you need is the cash inflow and the cash outflow. If you have the cash inflow and you have the cash outflow, then you can compute the internal rate of return without actually depending on any other external input. So the name is internal rate of return. Now it is how do we compute this internal rate of return? Internal rate of return, the computation is similar to that of NPV, but the only thing is that it is by definition it is that rate of return at which your NPV is zero. Okay, so which means now what is my NPV formula? My NPV formula was this summation t is equal to 1 to n cash flow at time t cost of capital to the party minus C0 was equal to, that was my NPV. Now this NPV is 0, which means this sum, the present value of my benefits, this figure is equal to my initial investment. This is the outcome. I mean, derivation of from this NPV 0. That means my present value of benefits is equal to the initial investment that I made, meaning that it is nothing but the rate of return from the cash flow streams that are available with me. So you see, this is for, I have done it for a single period to start with. Then this is your this is your IRR formula. Now the point is, how do you actually solve this IRR if, in case of real life projects? Now you can encounter different scenarios if you're talking about the computation of IRR. Now see, here is an example where we talk about this the cost of your this thing. I mean, the investment is going to be 20,000, and it will provide you annual cash inflow of 5,430 rupees for 6 years. Now, how do you compute the IRR? As you can see here, the 20,000 is equal to the present value of the annuity of this 5,430 rupees. So this factor is nothing but the present value factor, present value annuity factor. And what you can do is you can calculate this in case of you can use Excel to compute it within a with just fraction of a second, or you can simply use the tables available, the time value tables that are available to compute the internal rate of return. Now there is a table available, PVAF table. In fact, you have 4 time value tables available: compounding single cash flow, compounding annuity, present value single cash flow, and present value annuity. So you in this case you are going to use the present value annuity table. And now you got you are looking for a factor, present value annuity factor, which is 3.68. So what you will do is you look at the table, present value annuity table, and look for, you know that this is for 6 years. So look for the 6-year row, and please try to find out search the entire 6-year row and try to find out under which interest rate this value of 3.68 falls. So you suppose it falls under let us say 14%. It exact value might not be there. It could be, let us say you reach a value of 3.67. Okay, that's fine. So take that value, and and that falls under 14%. So your IRR works out to approximately 14%. That's fine if you go with the approximate figure. Okay. But the issue will arise if you have uneven cash flow. Now, you don't have a ready formula for computing the IRR if you have uneven cash flow. Now, for example, I'll give you an example of a uneven cash flow. Now, uneven cash flow is like this. To make it simple, I'm just going for 3 years. This is time 0, this is time 1, this is time 2, this is time 3. Suppose at year 0 you are investing 1,000 rupees and you are getting these amounts here. Now, if I ask you, these are called uneven cash flows. Now, if I ask you to compute the rate of return of this cash flow stream, obviously now you can compute because suppose it is just like you deposit 1,000 rupee and you receive 3 years 900, 600, 500. Then what is the rate of return the bank is offering? This kind of a problem. So here you are giving 1,000 rupee and you are receiving 900, 600, 500 over a period of time. So then how would you solve it? I'm afraid there is no ready-made formula to do that. You just have to go through the trial and error. That is, this is how the formula will look like. Your IRR. Now the n value here is 3. N value here is 3. So, okay, let me expand. Let me expand. The expanded formula is 900. 600, sorry, 600. 500 discounted 3 times. This is equal to 1000. Now, what you will do is this case you have to solve. The denominator case you have to solve. So you can, what you can do is you go on trying various values of k. You can try 10%, you can try 12%, you can try 15%, likewise. So you go on trying various values of k's and then find out the sum of this present value of benefits. Now the k at which this entire sum is closer to 1000 is the rate of return. Suppose let us say you use 10% and you get the sum of this present value of benefit sum is coming as, let us say, 1300. Then obviously that is not the rate of return. So then you try a different rate. You try 12%, you try 14%, you try 15%. So various rates of return you try. The value where you get closer to, you might not get the exact 1000 rupees, but you can get a value which is closer to 1000 rupees. So and that falls at a rate of, let us say, 16%. Then you can say that well, the internal rate of return for this particular cash flow stream is going to be 16%. So I'm afraid there are no other formulas for computing the internal rate of return, because if it is uneven cash flow, even cash flow you can do it in a single step. Here is an interesting thing for you people to notice. Now, the issue is that as I told you that IRR is that rate of return at which my NPV is zero. NPV is zero. So, which means there is an explicit relationship between the NPV and the IRR. Now, the point is, while we are discussing the even cash flows for IRR, we talked about this particular project. Now, suppose there is a project which is going to cost you 20,000 rupees and it will give you cash flow for the next 6 years of 5,430. This we have already discussed how to solve it. Now we saw that the rate of return that we derived was 16%. Now what I can do is I use different discount rates and compute the NPV of the project at different discount rates. Because how do I compute the NPV? I use this formula, summation T is equal to 1 to N cash flow discounted at K minus C0 is equal to NPV. Now here I use everything else remaining constant. I use various values of K and then I can derive the values of NPV. If I CT and CO, everything else remaining constant. If I've used various values of K, I'll get various values of NPV. Please keep it in mind that K and NPV has an inverse relationship. It is obvious, it is visible from the formula that K and NPV share a inverse relationship. That is, if you increase the rate of K here, the NPV will fall. So accordingly, if you see that if 10% your NPV is coming to 1300 and you need to bring down the NPV, which means that K has to be brought up to be able to bring down the NPV to 1000 level. So that is what I have done here. Now see, here I have used various discount rates. Obviously zero, the NPV will be just summation minus this thing. So 0. Then you have 5%. See, as I increase the discount rate, at 0 discount rate, the NPV was 12,580. Now, as I increase the interest rate, discount rate 5%, the NPV falls. If further I increase, the NPV further falls. And this drop in NPV will be registered till, as you go on increasing the discounting rate. At 16%, the NPV becomes 0. And then at 20%, it becomes negative. And at 25%, it again further becomes more negative. Now, the issue is, if I plot this data that I have got now, if I plot this data on a two-dimensional graph, that's a two-coordinate graph paper, where I am depicting discount rate in the x-axis and the NPV on the y-axis. So here I can plot the 0%, 5%, 10% and all that on the x-axis, whatever I have taken in the second column. And that is the third column probably in the table, which is written under discount rate. So discount rates, I can bring the values and plot them here. And correspondingly, what I'll do is 0 discount rate, I have a NPV. So I put it there. 5% discount is NPV, 10% discount is NPV. So I'll put all of these figures, this points on this graph, and then I subsequently join the graph dots. If I join the dots, this is the line that I am going to get. And this line actually is a very peculiar line, and this is the line of the NPV IRR profile. Now please have a look at this particular line. This line is intersecting the x-axis at this particular point of time. This at 16%. So it indicates that this is the IRR. Okay, and these are the rates which are the same rates. It's only the very special rate where NPV 0 is known as the IRR. All the remaining rates we can call them as the opportunity cost of capital. Now the point is, so please see that if your company's cost of capital, opportunity cost of capital is less than the IRR, which is your IRR is, let us say here 16%, but your company's required rate of return is 10%, meaning that you are going to be in the profit zone. Okay, you are going to be in the profit zone. This is the zone. This zone is your profit zone. Okay, but if your company's requirement is more than 16%, it is at 20%, then you are in the loss zone. Okay, so that is how crucial the NPV IRR profile is, and that is how crucial the IRR is for decision making. Now, what are the accept reject criterion here? The R stands for the IRR and K stands for the opportunity cost of capital. Now, you will accept the project when the internal rate of return is greater than the cost of capital. Now, my internal rate of return, let us say, is 15% and my cost of capital is 10%. So, nothing wrong in accepting the project. Now, why would I do that? I would do that, and vice versa. Suppose here it would have been let us say 10 and it would have been 15. Then I would have obviously rejected the project. And the point is, why? What is the logic behind this? The logic is, see, if you are investing in a project which is going to the IRR is going to be 15%, which means in layman terms, if I explain to you, if you put 100, if you borrow 100 rupee, obviously you are going to borrow 100 rupee because you are going to use the funds from the long term source. So if you borrow 100 rupee and invest it, what are you going to get? You're borrowing it at a rate of 10% and you're investing it at a rate of 15%. So this is 10% is your borrowing rate, your investment rate is 15%. Meaning that after 1 year, how much will you receive? 15 rupees you will receive. And how much you have to pay to this party? You have to pay 10 rupee. So the company earns 15 rupee on every 100 rupee and it returns 10 rupee to the supplier of the fund. So what will happen? Your wealth will increase by 5 rupee. Okay, that is the reason they say that if R is greater than K, you are in the positive zone and you accept. If R is less than K, that means the company is requiring 15%, whereas the project is offering only a rate of return of 10%. So obviously the organizations will not be benefited if they invest in this kind of projects. And if they are both the R and K they are same, then it doesn't matter where they are going to invest. You can invest in R, you can invest, you can invest in the project, or you cannot invest in the project. Well, in case of independent projects, the IRR and the NPV rules will give the same result if you don't have shortage of funds. But if you have mutually exclusive projects, if you have dependent projects, many times the NPV and IRR will give you different set of results. Now, you could have, for example, two projects. How under what circumstance this thing will give you different results? Number one, you have different life of the project. Life of the project in one case maybe 5 years, the other case it may be, let us say, 8 or 10 years. So there you can have this kind of a conflict, or you can have the size of the cash flows. Size of the investment. Suppose in one case you need to invest 10 lakh, the other case you need to invest, let us say, 50 lakh. So the size of the outlay will be different, and the time of your cash flows, that will also be different. Like in some project, the bigger cash flows will be happening in the early period, and in some other cases the the bigger cash flows will be happening in the later period. So depending on the sequence of your cash flows, also there could be difference between the NPV and IRR. Now, if NPV and IRR are a conflict, there are a lot of other ways to resolve these things. But ordinarily, we see that it always makes sense to stick to the NPV. Stick to the NPV because it is talking about benefits, more benefits in terms of cash. So it is always better to stick to the NPV under this kind of a circumstance. Then you have the last method. Under the last method, you have this profitability index. It is the ratio of present value of cash inflows at the required rate of return to the initial cash outflow of the investment. So this is a very closely related concept to the NPV. Now the formula is the present value of cash inflows by present value of cash outflow. Now see, how is it related to the NPV? See, the NPV formula is gross present value, the present value of cash inflow minus the initial investment, whereas the profitability index formula is gross present value by zero, the initial investment. Now, NPV will be positive only when this gross present value is greater than C0. Obviously, if that is the case, when NPV is positive, PI will always be greater than 1. Okay. So when NPV is positive, your PI will be always greater than 1. And when NPV is negative, the PI will always be less than 1. And if it is equal to 0, then, I don't stand to gain anything out of it. Okay. So If it is, positive, it is greater than 1. If it is negative, it is less than 1. So the formula for the profitability index is very similar to that of NPV. In NPV, we deduct the C0 from the gross present value. In profitability index, we just divide that with the C0. Now here I have a very simple example for you where we are computing the profitability index, and how do we do that? See, here you have an initial cash investment of 1 lakh, and you can generate cash inflow of 40,000, 30,000, 50,000, and 20,000 in year 1 to 4. So if you assume that your discount rate is 10%, the cash inflows can be discounted at 10%. So you pick up the values of the 10% from the present value single cash flow table. You can multiply them. You can use the Excel to compute the present values. You can simply do it with your scientific calculator as well. So the 40,000, 30,000, 50,000, 20,000, the present values have been computed by multiplying the requisite factors, and so we saw that the total present value now comes to 1,12,350 rupees. Now this 1,12,350 rupees is my gross present value. Now gross present value minus my initial investment, that is 1 lakh, it will work out to positive NPV of 12,350. But PIE, it will be 1,12,350 divided by 1 lakh, that it will work out to 1.12. Okay, so NPV says it should be accepted. The profitability index also says that it should be accepted. Now, because what is the acceptance rule you have? The acceptance rule is any project whose profitability index is more than 1, it has to be accepted, and any project whose profitability index is less than 1, it will be rejected. Because the reason is obvious. A project with a profitability index more than 1 will have a positive NPV, and the project with a profitability index less than 1 will automatically have a negative NPV. So it will be rejected. Well, if you have exactly 1, then the NPV will be 0. So you are indifferent between acceptance and rejection. So I guess we have come to the end of today's discussion. So what did we do in today's discussion is that we talked about the various kinds of investment evaluation criteria. To evaluate the investment, you need to first, we talked about the 3 steps of evaluating the investment criteria. We talked about the 3 steps of evaluation. So whenever you are faced with this kind of a scenario where suppose you whether you want to you have a machine, now you want to replace that machine with 5 different options available: machine A, machine B, machine C, D, and E. So what you can do is you first find out the initial value of the 5 machines. Okay, the machines will be different in value, and then if you use the machine, you have to first estimate the economic life of each of these machines. So different machines will have different economic life, and once you estimated the economic life of all the 5 machines, then you estimate over a period of time what this machine is capable of doing, translate that into the cash flow terms. So this is how the machine will be able to produce this many units, and these many units can be sold in the market, and the sales revenue is going to be this much. The cost will be deducted from that. That you get the profit figure. The profit figure will be adjusted for the non-cash items such as the depreciation and all. So you get the cash flow. So for all the economic life of all the projects, you compute the cash flows. Now you have the cash flows over for all the 5 farms. I mean 5 machines. You have the initial values, you have the cash flows. Your company has a cost of capital which you are already using. So using that cost of capital, you find out the present value of these things. If you are using, I'll tell you, ordinarily in industry, they use IRR is something that they talk about, but while evaluating the projects, they depend on two criteria. One is a evaluation, I mean the payback criteria. The second one is the NPV criteria. So now you have the skills. Once you have the cash flow, compute the payback, compute the NPV of all the five machines, and then you rank the projects according to the NPV, according to the payback period, and then you choose. Obviously, it is wiser to choose the rank one project which is giving you higher NPV, even if the payback is probably at rank one, two, or three. It always makes sense to choose the project which is giving you the highest NPV. So this is all about your project evaluation technique. Thank you.